Before we dive in, let's quickly understand what a SIP or systematic investment plan is. A SIP allows you to invest a fixed amount regularly in mutual funds, helping you build wealth over time through disciplined investing. Why are there not more people talking about how to protect their SIPs during a market crash? Please like, subscribe, hit the notification button, and share this video. Also, check the links in the description. The markets are crashing, panic is everywhere, but I refuse to let my investments suffer. I'm taking on the challenge to protect my SIPs and come out stronger. And in this video, I'll share my strategy to not just survive, but thrive during this market downturn. Let's go. First things first, no panic selling. The worst thing we can do is let fear take over. SIPs are designed to benefit from market fluctuations, and selling now would lock in losses instead of setting us up for future gains. Staying the course, but smartly. History has shown that market downturns are temporary, but discipline lasts forever. So, instead of stopping my SIPs, I'm sticking with them because dollar cost averaging ensures I buy more units at lower prices, reducing my average cost per unit over time. Reassessing and rebalancing my portfolio. I'm reviewing my holdings. Are my funds still aligned with my long-term goals? Do I need to reallocate between equity, debt, or international funds? This is the perfect time to rebalance strategically. Buying more at a discount. Markets are on sale, and I'm taking advantage. If I have high conviction funds, I'm increasing my SIP contributions while NAVs are low. Think of it as buying quality investments at a discount, keeping a cash buffer for flexibility. I'm making sure I have enough liquidity outside my investments, because the last thing I want is to redeem my SIPs in desperation. A financial cushion ensures I can stay invested without worrying about short-term needs, tuning out the noise and staying mentally strong. The media thrives on panic, but successful investors stay focused on the bigger picture. Market downturns can shake even the best of us, but corrections are temporary, and discipline is key. This is my game plan, and I'm sharing it with you so we can navigate this storm together. If you're in this for the long run, let's stay strong. Drop a comment below. What's your SIP strategy in this downturn? Let's discuss. Like, share, and subscribe for more investing insights. Follow for real-time updates on my investing journey. Sources: IND Money, Mint, Times. In this chapter, I'll dive deeper into the importance of diversification during market crashes. Diversification helps spread risk across different asset classes, reducing the impact of a downturn in any single investment. I'll share my top tips for diversifying your portfolio effectively. First, let's talk about asset classes. A well-diversified portfolio includes a mix of equities, bonds, commodities, and even real estate. This way, if one asset class underperforms, others can balance it out. For instance, while stocks might be tanking, gold often holds its value or even appreciates, acting as a hedge. Next, consider geographical diversification. Investing in international funds can protect you from country-specific risks. For example, if the local market is suffering, your investments in US or European markets might still perform well, providing a cushion for your overall portfolio. Sector diversification is equally crucial. Don't put all your eggs in one basket by investing heavily in a single sector like technology or healthcare. Spread your investments across multiple sectors to mitigate the risk of sector-specific downturns. Now let's talk about risk tolerance. Diversification should align with your risk appetite. If you're a conservative investor, you might lean more towards bonds and fixed income securities. If you're aggressive, a higher allocation in equities might suit you better. The key is to strike a balance that aligns with your financial goals and risk tolerance. Lastly, regularly review and rebalance your portfolio. Market conditions and your personal circumstances can change, making it essential to revisit your asset allocation periodically. This ensures that your portfolio remains diversified and aligned with your long-term objectives. Diversification isn't just a buzzword, it's a fundamental strategy to protect your investments during turbulent times. By spreading your risk, you can weather market crashes more effectively and stay on track to achieve your financial goals. What's your approach to diversification? Share your tips in the comments below. And don't forget to like, share, and subscribe for more insights on smart investing. Sources: Vanguard, Morningstar, Investopedia. Next, let's talk about the role of emergency funds. Having an emergency fund is crucial during uncertain times. An emergency fund acts as your financial safety net, providing you with the liquidity you need to cover unexpected expenses without dipping into your investments or taking on debt. How much should you ideally have saved in your emergency fund? Financial experts generally recommend having 3 to 6 months worth of living expenses set aside. This amount provides a comfortable cushion to cover most emergencies, whether it's a sudden job loss, medical emergency, or unexpected home repairs. Where should you keep this money for easy access? The key is to choose a safe and liquid account. High-yield savings accounts and money market accounts are excellent options. They offer higher interest rates than traditional savings accounts, allowing your emergency fund to grow while remaining easily accessible. Another option is a short-term certificate of deposit, CD ladder. This strategy involves spreading your emergency fund across multiple CDs with different maturity dates. It provides a balance between earning a higher interest rate and maintaining liquidity. Remember, the goal of an emergency fund is not to generate high returns, but to ensure you have quick access to cash when you need it most. Keeping your emergency fund separate from your investment accounts helps you avoid the temptation to dip into it for non-emergencies. Building and maintaining an emergency fund is a crucial step in safeguarding your financial stability. It complements your diversified investment strategy by providing a buffer during market downturns and personal financial crises. Do you have an emergency fund in place? How much do you think is enough? Share your thoughts in the comments below. And don't forget to like, share, and subscribe for more tips on building a robust financial plan. Sources: NerdWallet, Bankrate, The Balance. In this chapter, let's delve into the psychological aspects of investing during a market crash. And it's natural to feel anxious and concerned when you see your portfolio value dropping. However, making impulsive decisions based on fear can often lead to detrimental outcomes. First and foremost, it's important to stay calm. Take a deep breath and remind yourself of your long-term investment goals. Market downturns are inevitable and temporary. History has shown that markets tend to recover over time. One effective technique to maintain your composure is to limit your exposure to financial news. Constantly checking market updates can heighten anxiety and lead to hasty decisions. Instead, set a regular schedule for reviewing your investments, such as once a month or once a quarter. Another strategy is to focus on your investment plan rather than the daily fluctuations. Revisit your financial goals and the reasons behind your investment choices. If your goals haven't changed, there's no need to alter your strategy based on short-term market movements. Practicing mindfulness and stress relief techniques can also be beneficial. Activities like meditation, exercise, or even a walk in nature can help clear your mind and reduce stress. Remember, investing is a marathon, not a sprint. Keeping a long-term perspective and staying disciplined can help you navigate through market turbulence successfully. Have you experienced market crashes before? How did you manage your emotions? Share your experiences in the comments below. And if you found this video helpful, don't forget to like, share, and subscribe for more insights on smart investing. Sources: Psychology Today, Investopedia, CNBC. Educating yourself continuously can also help in managing your mindset during market crashes. Engaging with a financial advisor or a community of like-minded investors can provide support and insights. Automating your investments and maintaining a diversified portfolio can also reduce stress and improve long-term outcomes. Finally, I'll cover the importance of continuous learning and staying informed. The more you know about the market and your investments, the better equipped you'll be to make sound decisions. Start by subscribing to reliable financial news sources and investing blogs. Websites like Investopedia, Bloomberg, and MarketWatch offer valuable insights and updates on market trends. Consider reading books by renowned investors and financial experts. Titles like The Intelligent Investor by Benjamin Graham and A Random Walk Down Wall Street by Burton G. Malkiel can provide timeless wisdom on investment strategies. Attending webinars and workshops can also be beneficial. Many financial institutions and investment firms host educational sessions that cover various aspects of investing. Don't overlook the power of online courses and certifications. Platforms like Coursera, Udemy, and Khan Academy offer courses on financial markets, investment strategies, and personal finance management. Engaging with investment communities on social media can keep you updated and provide diverse perspectives. Platforms like Reddit, Twitter, and LinkedIn have active groups where investors share their experiences and insights. Lastly, consider consulting with a financial advisor. A professional can offer personalized advice and help you navigate complex market situations. By continuously learning and staying informed, you'll build the confidence to make well-informed decisions even during market turbulence. Do you have any favorite resources for learning about investing? Share them in the comments below. If you enjoyed this video, please like, subscribe, hit the notification button, and share it. Don't forget to check the links in the description. Sources: Investopedia, Bloomberg, MarketWatch, Coursera, Udemy, Khan Academy. Remember, knowledge is power. Stay informed and keep learning to navigate the market with confidence. At the end of the video, please grab a copy of the Kindle book, Get Rich by Investing by Craig Smith. He's the CEO of the CRAIGTRADER companies and a long-time experienced investor with a finance degree. This book can help any level of investor become better and more professional. The link to get it is the first link in the description. Thanks for your support.